Right now, as we move through the middle of the trading session on Wednesday, April 29th, 2026, Opendoor Technologies is trading at $5.42. We are seeing some subtle friction in the price action today, with the stock oscillating between a session high of $5.65 and a low of $5.24. This represents a slight downward drift of about 1.1% from the market open, which is interesting because it comes on the heels of a broader multi-week recovery. While a 1% move might seem like background noise for a stock as volatile as Opendoor, the real story isn't the price change itself, but the massive volume supporting it. We are seeing millions of shares changing hands as the market tries to decide if the recent rally from the $4 range has any real legs, or if this is just another bull trap in a long line of disappointments for long-term holders. The expectation for Opendoor has always been that it would eventually become the Amazon of houses, a seamless digital platform where you can sell your home with a few clicks. But the reality is far more punishing. While the market wants to believe that high-tech algorithms can replace the messy, human-centric process of real estate, Opendoor has spent much of the last year proving how difficult it is to manage physical inventory when interest rates refuse to play ball. The stock is currently sitting nearly 50% below its 52-week high of $10.87, yet it is up significantly from the terrifying 51-cent lows we saw in 2025. This creates a fascinating tension. If you look at the Robinhood app or your SoFi Invest dashboard, you might see a stock that looks like a bargain, but the institutional activity suggests a much more guarded stance. Big players aren't just buying the dip anymore, they are waiting for proof of life in the unit economics. What many investors are missing right now is the shift in how Opendoor is actually buying these homes. Early on, the strategy was simple: buy everything. Today, the reality is that they have become incredibly picky. They are using AI video inspections and proprietary vision models to find structural flaws before they even send an inspector. This has allowed them to keep their spreads wider, essentially charging sellers more for the convenience of a fast close. It is a necessary evil for the company to survive, but it also limits their growth. They are intentionally buying fewer homes to protect their balance sheet, which is a total reversal of the business model that originally made them a Wall Street darling. Recent stock movement has been driven heavily by the macro environment. We have seen the Nasdaq and big tech names like Nvidia stock and Apple stock provide a rising tide that lifted all boats, but Opendoor is starting to decouple from that tech-heavy momentum. It is being treated more like a leveraged play on mortgage rates than a software company. When rates at the bank or through your Fidelity trading platform look like they might stay higher for longer, Opendoor gets crushed. When there is even a whisper of a rate cut, the stock surges. This makes it a very difficult name for individual brokerage accounts to hold without a high tolerance for pain. Institutional activity has been mixed, with some hedge funds adding to their positions around the $5 mark, betting that the worst of the housing inventory crunch is behind us. The trading volume we are seeing today is reflective of a market that is looking forward to the next earnings report on May 7th. Analysts are projecting a loss of 6 cents per share, which would actually be a significant improvement over the 7-cent loss they posted in the previous quarter. The market is looking for any sign that the company can reach adjusted net income profitability by the end of 2026. If they can show that their new marketplace model, where they connect buyers and sellers without taking the house onto their own books, is gaining traction, the stock could easily retest that $10 level. However, if the inventory they do hold is still sitting on the market for more than 60 days, we could see a retreat back toward the $4 level. Let's talk about what this company actually does for a second, because the perception often differs from the technical reality. Opendoor operates what is known as an iBuying model. They use data to make a cash offer on a home, renovate it slightly, and then flip it. In a rising market, this is essentially a license to print value. In a flat or falling market, it is a dangerous game of hot potato. To mitigate this, they have been working closely with partners. Their relationship with Zillow is a massive part of their current story. Instead of fighting for customers, they are acting as the back-end fulfillment for Zillow's instant offers. This has drastically lowered their customer acquisition costs, which was one of the biggest leaks in their bucket over the past few years. When you are looking at investing sites or checking your interactive brokers platform, you have to realize that Opendoor is no longer the same company it was 3 years ago. They have gone through a radical reset. They have a new leadership team that is focused on being asset-light. They want to move away from being a giant house flipper and toward being a high-margin transaction platform. This is a much better business model on paper, but the transition is incredibly slow and capital-intensive. They are trying to prove that they can be a tech company in an industry that still largely relies on yard signs and physical lockboxes. If you are using a SoFi robo-advisor or an intelligent portfolio, you likely have a very small exposure to names like this because of the sheer risk involved. But for those doing self-investing or active trading on the Robinhood app, Opendoor has become a favorite for high-conviction bets. The retail sentiment is actually quite bullish right now, which can be a double-edged sword. We saw a massive retail-led rally in late 2025 that took the stock from under $1 to over $10 in a matter of months. That kind of movement isn't driven by fundamentals, it's driven by momentum and social media sentiment. The current price of $5.42 feels like a middle ground between that speculative mania and the cold reality of their financial statements. One of the big catalysts to watch over the next few months is the adoption of their zero-touch transaction. If they can truly get to a point where a home can be bought and sold with zero human intervention on the inspection side, their margins will fundamentally shift. Right now, they are still paying for a lot of human overhead, which eats into the thin margins they make on these flips. Their R&D has been focused on digitizing the title and escrow process to reduce closing times to just 3 days. If you've ever bought a house through a traditional brokerage, you know that a 3-day close is almost unheard of. That is the real value proposition here, not just the cash offer. However, the risk remains paramount. A sudden spike in interest rates or a regional economic downturn in markets like Phoenix or Atlanta, where Opendoor has a huge footprint, would be devastating. They still hold thousands of properties in their inventory. Even with more conservative valuation models, they are still exposed to the physical real estate market. This is why you see such a wide range of analyst price targets. Some see the stock heading back to $1.40 if the housing market stalls, while others have set targets as high as $8 or $9 based on the potential of their marketplace platform. Comment below how many shares of Opendoor you currently hold in your portfolio, and let me know if you think the iBuying model is actually sustainable long-term. The institutional holdings in Opendoor tell a story of cautious optimism. We see firms like BlackRock and Vanguard maintaining their positions, but we haven't seen a massive influx of new institutional capital recently. They are in a show-me phase. The market has been burned by the growth at all costs narrative before, and now it wants to see actual cash flow. The company did report its first quarter of positive adjusted EBIT last year, which was a huge milestone, but they haven't been able to sustain that consistently across the board yet. The cash burn is still a concern, even if it has slowed down significantly from the billion-dollar losses of 2025. If we look at the competition, companies like OfferPad are struggling even more, while Zillow has essentially exited the direct buying business to focus on being a platform. This leaves Opendoor as the last major player standing in the iBuying space. In many ways, they have a monopoly on this specific type of transaction. If the consumer demand for convenience continues to grow, Opendoor will be the only place people can go for a guaranteed instant sale. This gives them a massive long-term advantage if they can just stay solvent long enough for the market to turn in their favor. As we look toward the end of the year, the central theme for Opendoor will be whether they can hit that profitability goal. The expectation is that they will continue to struggle with low inventory and high mortgage rates. The reality might be that their partnership with Zillow and their new AI tools provide enough of a margin cushion to surprise everyone. We have seen the stock defy gravity before, and with the high short interest that often follows names like this, any positive news can trigger a massive squeeze. Whether you are looking at Opendoor through the lens of a long-term investment on your Fidelity mobile app or as a short-term trade on Interactive Brokers, the key is to look past the daily noise and focus on the unit economics. Are they making more on each house than it costs them to buy, renovate, and sell it? That is the only question that matters. Everything else is just sentiment. The 5.42 price point we see today is a reflection of a company that has moved past its near-death experience, but hasn't yet proved it can thrive in a high-rate environment. To summarize, Opendoor is currently caught between its past as a reckless growth stock and its future as a disciplined tech platform. The recent price action suggests a period of consolidation as investors wait for the May 7th earnings report. The gap between the expectation of a housing tech giant and the reality of a company still fighting for profitability is where the opportunity and the risk lie. It remains one of the most polarizing names in the real estate sector, but for those who believe in the digitization of the home selling process, it is the only real game in town. The volatility isn't going anywhere, and for a stock that has moved from 50 cents to $10 and back to $5, you have to be prepared for anything. Stay grounded in the data, keep an eye on those mortgage rate trends, and remember that in the world of iBuying, the balance sheet is everything. Use your tools, whether it's your individual brokerage account or professional grade platforms, to keep a close watch on the volume. If we start to see a sustained increase in buying volume without a corresponding drop in price, that might be the signal that the institutions are finally ready to step back in. Until then, it's a high-stakes waiting game.